Marcus Bogdan joining us from Blackmore Capital. Marcus, very good to talk to you this morning. Thanks for joining us. Let's start with the banks. Now, of course, this is going to be the negative, then we'll go to the positive, shall we? Of course, we saw that result from CBA yesterday and the huge drag it had on the market. How are you looking at the banks at the moment, particularly as far as those net interest margins are concerned, which is clearly the concern?
Good morning, Andrew. Well, the result from CBA yesterday was a shock. Less so from Westpac and the other retail banks, but CBA, from a quality perspective, has been an absolute leader for a number of years. And so that emphasis yesterday on the reduction in NIM, the underlying NIM reduction of around 7 basis points, plus persistent expenses resulted in a result which was about 4% below market expectations. But it did illustrate that the trends that you saw in Westpac in the previous week are now starting to affect CBA. So I think it does cause a pause in our thoughts around the banking sector. They were one of the core drivers of such strong EPS growth in 2021. That growth will moderate a great deal in 2022. And so it's, in the end, it's an emphasis there on much higher competition, particularly in mortgages, and that persistence on expenses. Offsetting that, credit quality still remains very good. The balance sheets of the Australian banks are in very strong condition, and we should still be able to see some dividend growth and some further buybacks. But the net result yesterday was absolutely disappointing.
So you would say that re-rating of banks is justified on the negative side, and you can expect more to come beyond what we've seen with CBA?
Well, you had an 8% pullback yesterday with a sort of reductions going forward of earnings growth earnings reductions of around 4 or 5%. So it met that yesterday, but I think the key question is, will CBA be able to maintain the premium that it's been trading against the other retail banks? I still think it does justify a premium. They are growing above system, and they've got sort of a very strong deposit base, and they are doing some very good things in technology, but there could be some further pressure there on the premium that CBA trades to the others.
Marcus, are you happy to have any exposure to the financials at the moment?
I think so. I think so. I think the dividends are sound. I think the dividends can still grow, and I think the balance sheets are still strong. But that exponential change that we saw last year, you're just not going to see that repeating going forward, and so that the earnings growth going forward will be far more modest from this point of view. But there's still a justification to having some exposure to the retail banks.
Let's stick with the negatives then. As I said before we get to the positives, resources. And of course, so much as this is driven by what's going on in China. What sort of exposure do you have to the resource sector?
Primarily through BHP, and that iron ore price of over $200 was never going to be sustained over a period of time. It has pulled back dramatically to around $90 now. But the resource companies are still achieving very high returns on capital, very strong discipline in that area, and underpinned by incredibly strong balance sheets. And so I think the biggest falls now that we've seen from sort of plus 200 to around $90, and even if you take a sort of a long-term trajectory of iron ore prices of around $70, they're back. These resource companies now are back to sort of fair to modest value.
Well, Marcus, let's move on to the positives. Maybe some green shoots that have been coming through this earnings season. What have you seen? Where do we start?
Well, you're absolutely right. You're seeing an absolute bifurcation in the market from resources and banks. But on the industrial side, on the healthcare side, and some of the media and digital property side, you are seeing more positive statements coming out of those companies. Importantly, on the industrial side, companies like Cleanaway, Goodman Group, and Cube have all suggested that they're seeing stronger growth in their underlying businesses, which is particularly encouraging. And they are really important components of the overall economy. And I think that those trends will continue as we reopen and as we move into the sort of the federal election, where I think you'll see greater fiscal stimulus there as well. A number of healthcare companies in the diagnostic side of things are starting to see some improvement, and you're also starting to see some real tangible improvements in CSL. And then finally, in the digital property side of things and the media exposure, News Corp had a much stronger result than that was expected. So there are definitely parts in the economy which are going to participate in this reopening. They've been able to pass through the elevated prices that we're seeing with inflation. So from that perspective, that's a positive. And overall, we are seeing more positive revisions than negative revisions.
All right. You mentioned media and digital specifically. Which companies are you looking at there?
Well, primarily through News Corporation, which is their sort of the biggest contributor is their investment in REA. So they are benefiting from the uptick there we're seeing in housing prices and housing volumes. They're seeing a wonderful recovery in their US digital property business in Move. And then in their media business through Dow Jones, you are starting to see very good uptakes in subscriptions and very good pricing power there as well. And so when we look at News Corp, it still trades at a significant discount to the sum of the parts. We may see an IPO with Foxtel going down the track, which will again add some further value to the underlying business there.
Marcus, given the sideways nature of this market at the moment, and as you said, it's pretty mixed out there, how much cash do you have on the sidelines waiting for an opportunity?
Well, we've got about sort of 7% cash in the portfolio, so that does give us a little bit of flexibility to look at either a new position, or if we do see sort of a pullback or elevated volatility, that we can add to positions there. But you are right. I mean, the markets are moving sideways, and I think from an index perspective, I think we've seen the greatest gains there now. So it is very much now about stock selection and portfolio weighting in the portfolios.
What difference are you seeing, given we're seeing record high after record high on Wall Street at the moment? I mean, clearly part of that being driven by those stellar earnings results we got for the third quarter. What difference are you seeing as to why the Australian market is dragging at the moment? And of course, the States, they're talking more to come with perhaps the Santa rally upon them.
Sure. I mean, the earnings momentum in the US continues, but I think the construction of the US indexes compared to the Australian indexes are quite different. We don't have that sort of that technology footprint that the US markets have. And remember, the Australian market, materials, which is the resource sector, and the banking sector is a very big component of the overall index. And now we're sort of seeing sort of negative revisions there, and that's obviously weighing down on our market. And that's why I think you need to look at the individual sectors to sort of get that increased alpha in your portfolios.
Yep, back to where we started from, the negatives, just as far as the banks and the resource stocks are concerned. Marcus, thanks for joining us from Blackmore Capital.
Pleasure, thank you.